Hi there, welcome to FVAS. In this video, our team breaks down capital gains tax on UK property disposals for the 2026.
Picture a small business owner who finally sells that buy-to-let property they've held for a decade. The sale clears, the cash hits the account, and they are now expecting a major, life-changing financial windfall. But the clock is already ticking. From the exact date of completion, the seller has precisely 60 days to report the gain and pay the tax bill to HMRC. Then comes a secondary shock. They discover their annual tax-free allowance, the amount of profit they can make before paying a single £1, has dropped to just £3,000, a steep decline from historical averages. I'm here with Fairview Accounting Services. Today, we are breaking down exactly how to navigate capital gains tax on UK property sales in the 2026-27 tax year. With a razor-thin 60-day reporting window and heavily restricted allowances, attempting retroactive tax planning after the sale closes is impossible. Your only defense is a proactive strategy. To understand why the 2026 tax landscape requires specific attention, we need to look at an economic condition known as fiscal drag. This shows fiscal drag. While wages and asset values climb with inflation, income tax brackets are frozen flat at $50,270. As your gains naturally grow, they spill over this static line. With only a $3,000 exempt amount, the remainder sits fully exposed to taxation. Fiscal drag functions as a stealth tax. It silently pulls unaware property sellers into higher, more expensive tax brackets without Parliament ever needing to announce an official rate increase. Let's establish the baseline rules. If you are selling your primary home, you are generally shielded from capital gains tax entirely through private residence relief. The rules tighten when you look at secondary assets. Second homes, holiday properties, and buy-to-let investments are all fully subject to this tax. For 2026, the specific rates for property gains are 18. The remaining £126,730 spills into the 24% bracket, leaving our freelancer with a tax bill over £31,000. If sellers do not execute this mathematical funnel prior to listing their property, they will drastically miscalculate their expected net profit at closing. Once the sale is complete, the clock starts. You have exactly 60 days to digitally report the disposal and pay the estimated capital gains tax to HMRC. Many sellers mistakenly assume they can wait until their annual self-assessment return in January. Missing the 60-day deadline triggers automatic escalating financial penalties and interest charges. When calculating the gain, many landlords also fail at the allowable cost stage, falling into the repairs versus improvements trap. This blueprint illustrates the strict difference. Like-for-like maintenance, like patching a leaky roof, is considered a repair and is not deductible. But permanent capital improvements, like building a new conservatory, can be deducted from your taxable gain. Failing to properly categorize maintenance versus a true structural enhancement will artificially inflate your taxable gain and risk severe scrutiny in an HMRC audit. Rather than just reacting to compliance deadlines, you can use the rules to actively minimize your liability before you sell. A powerful mechanism is the no gain, no loss rule, which allows you to safely transfer property ownership between spouses or civil partners without triggering a tax event. As we see in this diagram, transferring a share of the property allows the household to utilize two separate allowances, doubling their total tax-free threshold to £6,000 for the year. You can also make use of strategic timing. Delaying a property sale to a tax year where your standard income is temporarily lower, perhaps during a sabbatical or retirement, can keep a larger portion of your gain out of the 24. Capital gains tax operates as a highly mechanical system. It is rigorous, but it responds favorably to deliberate timing and careful ownership structuring. To summarize your 2026 playbook, remember the £3,000 allowance, calculate against 18% and 24% rates, adhere to the 60-day deadline, and log allowable improvement costs. Please note this video provides general guidance. Because the tax code interacts differently with everyone's unique financial footprint, your individual circumstances will require professional advice. That is exactly where Fairview Accounting Services steps in. We act as your partner to structure, execute, and report your property sales legally and efficiently. You can reach our tax specialist directly by calling 0330-133-3537 or by emailing inquiries@fvaccounts.com. Subscribe to the FVAS channel today. Ensure you never face shifting HMRC regulations without expert guidance.